And welcome back to our third conversation we're having about our friend inventory and cost of goods sold, my assets on my balance sheet, plus my associated impact through an expense on my income statement. So we've gone through the process of saying, hey, you can either use specific identification if you keep track of every inventory item that you sell, or US GAAP allows us to make a couple of assumptions, either that the first inventory items, your first layer of inventory, are the first ones that you try to sell. Your last layer of inventory, your most recent purchases, are the first ones that you try to sell, or we take an average of them. So now we've determined how we can calculate cost of goods sold. We now need to record that to get it into our accounting system. So we have a couple of different systems that we can use. A lot of companies will use a perpetual inventory system. And this is when it's a continual record of inventory on hand gets booked. Okay. So every time I every time I make a sale, I am booking that sale and I am booking my associated cost of goods sold. So it kind of, for more advanced and sophisticated accounting softwares, this is what companies are going to use. And really, it just helps with the timeliness of things, right? Because I know a constant updated record of my inventory items. The other system that you could use is called a periodic inventory system. And a periodic inventory system does not continually record inventory amounts. You simply calculate the balance of inventory at the end of the period based on a physical count of inventory in your warehouse. And I adjust for purchases and the sale of inventory. So if you're a really big corporation, you probably use a perpetual inventory system. If you're a smaller business, you might use a periodic inventory system. Okay. So think back to our Mario GameStop transactions where I had different layers of purchases here. I went through and I assigned my cost of goods sold based on my products that I sold. And now I'm going to think about how that is impacted from a journal entry perspective. Okay. So I've already done these calculations. And if you have any questions about how to calculate those, I would suggest going back to part 2 of this video, because here now we're saying I know how much I have, right? And now I'm going to go book those. So the first thing I have is that I go through and I sell some inventory, and I sell inventory on account for $4,500. Now I'm going to take a step back here, and I am going to say the first thing that I want to do is I want to acknowledge the purchase of this inventory. I must have missed a slide in here. Okay, so I am going to say, what is the journal entry on April 25th when Mario goes out and purchases this inventory? What is he getting when he purchases inventory? Well, he's getting inventory, right? And how much worth, how much is he getting worth of inventory? Well, he's getting $2,700. And now I'm going to tell you that he purchased this on account. Okay. So instead of paying cash, he's establishing an accounts payable and telling his vendor that he's going to pay them later. So now I've booked one journal entry to kind of start this process. The next thing that we have is this July 17th purchase or sale, where he sells 300 units for $15 a piece. So with a perpetual inventory system, when you sell inventory, it will always trigger 2 journal entries. Okay. So what's going to happen here is we need to record, hey, I sold inventory on account for $4,500. Did a customer give me cash? No, they gave me a promise to pay me cash in the future. I have an unconditional right to receive this in the future because I did what I needed to do. I gave you a product. So I get to recognize accounts receivable, and this is on 7/17 for $4,500. What else happens? What do I get to recognize? Well, I get to recognize my sales revenue. Because again, I sold you the product. I've done what I needed to do to recognize that revenue. But have I at all accounted for the fact that I have a cost associated with this? Well, no, I haven't. All I've done is increase an asset and increase a revenue amount, which increases shareholders' equity. Okay. So I also need to book on this same day my cost of goods sold and my reduction in inventory. So how do I calculate that cost of goods sold if I am using a FIFO method? Well, I'm going to say I sell 300 units. I know that I'm going back over here and I'm assigning them based on my first layer of inventory. So I have 100 units from my first layer of inventory at $7 plus 100 or 200 units to get to the total 300 that I sold. And I bought those at $9. So I have a total of $2,500 of cost of goods sold that I need to recognize. And that cost of goods sold also shows my reduction in inventory. So what is my company's profit? Well, I'm able to sell something for $4,500 that only cost me or have an expense of $2,500. So I have profit on this sale of $2,000. So I did pretty good. But notice, right, how I need to be able to calculate my cost of goods sold to book this journal entry. So I have to be confident in my ability to do that in order to journalize it and get it in my records. So what are the journal entries on October 19th when I purchased the inventory and on December 15th when I make the sale? Well, what's going to happen, right, is October 19th, 1019 over here, I go out and purchase inventory. So I purchase inventory at 600 or 600 units at $11. I'm going to go ahead and tell you that I purchased it on account. So my inventory is going up by 6,600 and I am going to pay my vendor later. Okay. And I should probably be more explicit in letting you know that, but I'm telling you, we're going to pay him later. So now what happens is on December 15th, I have a sale. How do I calculate what happens when I have this sale? Well, it looks like I have 500, right, units that I am selling at 15 a piece. So I'm going to book sales revenue, okay, of 7,500, which again is 500 times my 15. And I'm going to tell you that they are paying me on account for 7,500. Now, when I recognize, right, that I am booking a sale, I also need to recognize my cost of goods sold, right? The cost of selling that product and the reduction of inventory. So under my FIFO method, make sure you can calculate this. I will have cost of goods sold of 5,300 and my inventory will be reduced by 5,300. So can we make the inventory T account? Well, yeah, absolutely. I know that I have beginning inventory of 700. I know I have a purchase, right, on April 25th for 2,700. I know I have a sale, right, of 2,500, reducing my inventory on July 17th. I know I purchase additional inventory, right? So I have a purchase over here on October 19th of 6,600, but I know I have another sale of inventory of 5,000 or 5,300, my gosh, on the 15th, which represent my sales. So I get my ending inventory to equal 2,200 bucks after going through this process. So the perpetual inventory system, it maintains that continual or perpetual record of inventory purchased and sold. They're going to increase that inventory account, and when they go through purchasing, okay, they increase inventory when they purchase. They decrease inventory when they make sales. And when they make that sale, you also have to recognize your cost of goods sold impact as well. So now we can think about a couple of other inventory transactions. So the first is going to be what we call a purchase discount. So if you think about a purchase discount, okay, what that means is that it's the opposite of a sales discount, which is what we learned about in chapter 5. So now I'm on the other side of the transaction over here, where I'm saying I'm getting a discount for paying my vendor quickly. So the way that we account for that, okay, is I'm going to reduce, right, the accounts or the amount of inventory that I have. And I'm going to say my inventory is going down by my purchase discount amount. Okay. And I will also recognize a reduction in my accounts payable of 54. So think about what I've just done. I've said I'm reducing my liability because I'm not going to actually have to pay you 54 bucks because I paid you quickly, so I got a discount. And I'm also reducing that asset. Now that asset isn't actually really fundamentally going down, right? But I don't house this in like a contra account like we do from a revenue perspective. Okay. I keep it on its own. So what you probably are really going to see is when somebody pays, because the other side of this transaction is going to be that the cash is actually going out the door as well. So the bones of the journal entry is probably going to be, hey, I'm reducing my accounts payable. I'm reducing my inventory by my purchase discount amount. And I'm recognizing cash going out the door. Okay, so that's the full journal entry here. What we did isn't taking into account the cash that's going out the door because we didn't have that stated in our example. So again, not a purchase discount, but a purchase return. So if Mario received some defective inventory and wanted to return it, well, all he's going to do is recognize that that inventory is going down, right? He's sending it back. It's not a resource to me because I don't have it. I'm sending it back. But I am also going to reduce my accounts payable because if I send you the inventory back, I don't have to pay you, right? Okay. So that's kind of what that's going to look like from an additional inventory perspective. So here is a good comparison between the purchaser and the seller. And this isn't our Mario game transaction, right? This is a different example. But you can see when I'm the purchaser, I purchase something on account, I return some inventory, and then I pay with a discount. So notice how this mirrors the exact journal entries that we just booked. But think about how that differs from the sellers. Because what is an asset to me, okay, is a liability to you. So instead of me having to pay you, well, you have somebody that's going to pay you in the future, okay? You're recognizing revenue because you sold that inventory to me. Sales returns, notice that I have this contra account. I don't have a contra account over here as the purchaser. I just directly reduce my inventory account, okay? And then lastly, again, as the seller, I have this contra account. Well, I just reduce my inventory from the purchaser's perspective. So we have to be cognizant, am I on the purchasing side or am I on the selling side? Okay. So that's a little bit different than a periodic inventory system. And this periodic inventory system just adjusts things as what it says periodically. So when I adjust things periodically, what that means is I don't continually modify it. I have purchases and sales of inventory. So we're going to work through this for Mario's GameStop transactions again. And we're going to say on April 25th, I purchased some inventory for 2,700 bucks on account. So what is my journal entry when I book that or when that happens? Well, I am going to recognize, right? Hey, what am I getting? What am I getting? Well, I am getting, right, inventory, but under a periodic system, I use a temporary account called purchases. Because again, I'm not perpetually updating that inventory account. I'm throwing it in this purchase account. And I'm saying I'll pay you later. Sounds good. I have an accounts payable for 2,700. When I sell inventory on account for 5,000 or for 4,500, notice, okay, a customer's promising to pay me later. I have an unconditional right to receive that. I have accounts receivable of 4,500. and I get to recognize my sales revenue because again, I have earned that. Do I have a journal entry for cost of goods sold? Do I need to update my inventory balance? Well, no, I don't. I have no journal entry for COGS under a periodic system because I periodically at the end of the period will adjust that balance. But I don't have a journal entry for it at this point. Okay. So now I have an additional consideration, which is when I pay freight charges. So when I pay freight charges, I'm going to establish a freight in account, a specific freight in account. And freight is probably like shipping costs associated. You might hear like FOB destination, FOB shipping point, right? So I have freight in, that says in, not inventory, sorry, of 300. And I'm paying cash because it says I pay freight of 300. Now I see that I'm paying on account with a 2% purchase discount of $54. So I have a purchase discount related to this purchase right here. So the first thing that I'm going to do, okay, is I'm going to get rid of my full accounts payable that I established. So I have an accounts payable that I am fully extinguishing of 2,700. Now, under a periodic system, different than perpetual, I actually do have a purchase discount account of 54. Okay. So under this periodic, because remember, under perpetual, I just hit my inventory account directly. Well, I haven't messed with inventory at all under periodic. I haven't established any inventory. Okay. So I don't have an inventory account to adjust. Okay, so I hold it in my purchase discount temporary account, and I recognize the cash going out the door for 2,646, which is simply a plug figure. Now I'm going to return inventory previously purchased on account. So I have a purchase return. Again, think about how it's different between a perpetual system and a periodic system. Under a perpetual system, I would impact my inventory account because I have one. Under a periodic system, I have not established an inventory account. So similar to how I have a purchase discount up here, I am going to have a purchase return. Okay. So I'm going to say I purchased it on account. So I need to back that accounts payable off my books. It's not a liability. I don't have to pay it. I'm giving it back to you. Then, similar to a purchase discount, I have a purchase return account, right, that I'm going to hit for $550. So this is different than perpetual because perpetual, I hit inventory in all of these specific examples. I don't have an inventory account to hit at this point. Okay. So the last thing that we need to do under a periodic is have a period end adjusting entry. Okay. And this period end adjusting entry is only needed under the periodic because it accomplishes getting my balance of inventory to what I need it to be. Why do I not need that under period or perpetual? Because my inventory account is always being impacted and the most up to date. So I record my cost of goods sold for the entire period because I didn't have individual cost of goods sold journal entries throughout this time, right? And I close out all of my temporary purchase accounts. So what I'm going to do is I am going to say the first thing that I need to get off of my books is my beginning inventory. So I'm going to come down here and get my beginning inventory of $700 off of my books. Now, what I'm going to do is I'm going to have my inventory be up here as a plug figure. Okay. So the reason that I do that is because I need to perform a account or an inventory count of this. And that inventory count is going to tell me how much is in my account. So this again is going to be given based on a physical count of inventory. All right. So now, what accounts do I need to get rid of? Well, I need to get rid of my freight account of 300, and I need to get rid of my purchase accounts. So I have purchases. Remember, I would have purchases for this, but don't you think I also have a purchase for this? So we didn't book this journal entry. We can go ahead and do that now on October 19th when I have my purchase account that I am going to impact for 6,600. And I say I'll pay you later for 6,600. So I have total purchases, right, of 2,700 and 6,600 for a total purchase balance of 9,300 that I am going to come and get off of my books now. 9,300. What other purchase accounts do I have? Well, remember, I have my purchase discount that I need to get off my book, which was a normal credit balance. So I get it off my book and undo it with a debit for 54. Same thing with my purchase return here. I had that on my books as a credit balance of 550. So I need to debit my purchase returns to make it go to 0. And that is for the same 550. And then all of a sudden, I finally record my cost of goods sold here. And that is going to be what is called a plug or a fill figure to get this journal entry to balance of $8,046. Okay, so I figure out my cost of goods sold last. I have to get my beginning inventory off my books and restate my inventory at its current balance, which is based off of a physical count. And then I remove all of my temporary items here. So all of my purchase specific accounts, I have to remove those guys. So periodic inventory system summary is that I record purchases, freight in, purchase account, or purchase returns, purchase discounts, and temporary accounts, and I have to close them out because I don't hit them in my inventory account because, again, I haven't established that at all. So we just went through the process of closing that out. And notice again, right, I do not have perpetual increases and decreases of inventory. So I also don't recognize my cost of goods sold when I sell these products. I do that at the end of the period. So that wraps up this video. I will see you next time for the last conversation that we're going to have, which is the lower of cost and net realizable value. So I'll see you guys in the next video.